Welcome to the unveiling of untold history documentaries, mastering classes in business management, and sparking insights through money dialogues. This is JephKafka TV, where you discover untold business histories, master the art of management, and ignite money conversations that matter.
Welcome to JephKafka TV. I hope you're okay. Today, we are going to discuss about taxation. Karibu. If there was a word that if you had a choice, you'd never want to hear it again, what word would that be? I'm guessing a lot of people would say taxation. Yeah, taxes. Nobody wants to be taxed. Nobody wants to be told that taxes are going to be increased. Nobody wants, the idea of, taxation in his or her life. But as much as you'd oppose to hearing the word taxation, the government would much be more interested in hearing and executing taxation. And if we are to talk about taxes, I want us to do it in a very systematic way. This will be a three-part series whereby, first of all, we shall introduce taxation. We'll know what it is, the kinds of taxes that there are, and then we'll look at how can we as individuals avoid taxes. And I'm talking about tax avoidance, which is a legal way that accountants engineer to help you pay less or zero taxes. And in part 3, we look at corporates. How can you as a corporate, as a big business owner, avoid taxes altogether? So this is JephKafka TV, and you're most welcome. Please subscribe, keep it here, share with your friends. And if you have any questions or any comments that you would like us to improve on, kindly do not hesitate to comment. Taxation started, I would say, from a very bad footing. And this is how. There's a theory called the stationary bandit theory. And I want to explain it in a very few words. Actually, in a story. Long ago, in civilizations not yet born, people used to stay in villages or small towns where they did whatever they did, whether it was trading, whether it was farming, whether it was fishing, whatever that brought them an income or whatever made them a society. They used to do that. But these people had a problem. And the problem was that there was another group of people who did not like to work, but liked to steal what these people or these villagers produced. And those thieves were called bandits. Specifically, roving bandits. Bandits who would come to this village today, then move to another village tomorrow. The other day, they rove to another village. Roving bandits. Roving bandits were infamous for plundering whatever they found in that village. They would sometimes injure the people, but their main interest was stealing the food or the goods, the animals, the produce, whatever they found in that village. And the people in those villages got tired. They couldn't stand up in arms because they were not trained in the army. They were not trained to be fighters. They were trained to be doing what they were doing. Whether it's mining, farming, fishing, that's what they did best. But they knew every now and then the roving bandits would come, plunder their stores, injure their men, and they would start all over again. So they had this great idea. And they had their representative whom they sent to the bandits to represent their grievances. Okay, I'm not sure whether the first message ever returned because the bandits were not, in a mood to listen. But they kept on sending the messages until one of the messengers was heard. And this was his message. He told these bandits, what if you stay in our village? What if you stop being a roving bandit and instead you become a stationary bandit in our village so that whatever we produce, instead of plundering everything else around us, we'll just give it to you, But then you have to protect us from other roving bandits. And the bandits were surprised, but then when they thought about it over their glasses of gin and rum, they were like, okay, I think that's something we can do. We can stay in your village. We can watch over you as you produce. And then at the end of the month, you bring us a part of your product. And both of us will be happy. And it so happened that these bandits now, instead of roving, became stationary. And these villagers now started producing more. And whatever they produced, a part of it they give to the bandits. And the word spread around the other villages, and they also started establishing stationary bandit stations where the robbers, instead of stealing from them, now they were getting whatever they were stealing for free, but at a fee, maybe for protection. And as time evolved, these bandits now started forming systems. They wanted to make roads for people who are far, so that when they produce, they can be able to bring their goods to their station. They started forming armies to be able to prevent other roving bandits from attacking their village. So they started doing what we'd call social amenities, schools, hospitals, etc. But fast forward, we had civilization, and we legitimized an illegitimate banditry system and called it government. So the government has become the stationary bandit. The village has become the country. And whatever the bandits were stealing, that is goods and whatever else, we now give it to the government and we call it taxes. So that is the genesis of taxes. So from that story, you can get your definition of it. Do you think it's voluntary? Do you think it's involuntary? Do you think it's forced? Do you think it's necessary? But now, since it's part of life, now someone said that the two most definite things are death and taxes. And one might cause the other. In most cases, taxes might cause death. And even when you die, there's a stamp duty to be paid for you to get that certificate. So both cause the other. Now, in Kenya specifically, what taxes are there? How do we go about it? How do we understand the concept of taxation? Let me explain. So the textbook definition, levy charged by the government on incomes. So it means for a taxation to happen, there has to be an income. And our work here now is to define what is an income. So income would be something that has been generated by either an individual or a business in exchange of maybe goods and services. For instance, when individuals exchange labor with the employer pays them something at the end of the month. So the first kind of income is that from employment. And the second kind of income, that is a major income, is business income. Now, business income can further be classified into other categories because there is business earned by individuals and there is income earned from businesses that are corporates. So individuals in this case would include sole proprietors and partners. And corporate in this case, mostly we're talking about companies that have been registered by the Corporations Act, things like NGOs, things like societies, etc. So taxation is on income. Income can be generated by individuals, and income can come from two of these places: businesses, employment. And here I could also add rent income. Again, this can be associated to an individual or to a business, but it's also a separate kind of income that the taxman looks at. So the first thing I want us to look at is the employment income. Question: what is employment? Simply means that there is an employer somewhere who is running an enterprise, a business, or whatever it is, and at the end of a regular period, whether it is a week or a month, the employer pays you as the employee a benefit that could be in form of cash or could be in form of non-cash. So an employer who pays you in form of cash means that they are paying you the salary which you receive in cash, or they are paying you a bonus which again you receive in cash, or they are paying you a commission. Maybe you're employed by a company that has sales, and at the end of the week or month, you're told whatever amount of sales that you made, there's a commission that will be compensated for that. Other employers give you non-cash benefits. They are still payments that the taxman looks at. These non-cash benefits include housing. If the employer has provided you housing or a vehicle, sometimes house helps, airtime, entertainment, all these other things, we would call them non-cash benefits. And the taxman will look at all these as your benefits from employment and will seek to tax you on that amount. The one that we are very familiar with is the salary. That when you go to a job interview, the first thing that they ask you, or the last thing that they ask you, is how much do you expect to be compensated? You state a figure, which is the gross salary. Based on your performance at the end of the year, or based on the company's general performance, you may or may not receive a bonus, which again is a form of a benefit from employment. Based on the form of employment, if you're a salesperson or you are required to get clients for a certain thing and you earn a commission on the same, then that is also a form of income. And then there are the non-cash benefits that you've talked about. So what happens? From employment, the employer will prepare the payroll at the end of the month. And from this payroll, the employer is supposed to cut the tax amount that is due to KRA and call it the pay as you earn. So the pay as you earn is not a tax. The pay as you earn is the collection point of the tax amount from employment, because you're not the one, the employee is not the one who remits it to KRA, it's the employer who remits to KRA by deducting it at the point of pay. So the pay as you earn is the point where you deducted the tax amount from your cash and non-cash benefit, and the employer remits it at tax now to KRA. So when you go to your iTax at the end of the month, you'll find how much the employer deducted from your pay and how much was paid to KRA for that month. Now, several things happen here. the employer has to calculate, one, your gross pay. From your gross pay or to your gross pay, he adds other benefits. So he will add the bonus that you've earned, he'll add the commission that you've earned, he'll add, based on the provisions of KRA, the amount from the housing that he has given you, the amount from the vehicle, the amount from other benefits that he has given you. But one thing has to be made clear, one distinction has to be made clear about these non-cash benefits, that whatever is taxed should be for personal enjoyment. Meaning, it's not supposed to be a tool to help you to do your work. For instance, if you're a salesman and you're given a vehicle and the vehicle is supposed to be used for making sales, then that is not a benefit and you shouldn't be taxed on it. But if you're a manager and one of the benefits is having a car that you can use to go to work with, carry your family around during the weekends, then that is your personal enjoyment. The same way, if you are a doctor or a nurse and you're supposed to reside within the hospital will provide you with housing. And it's giving you the house because it's a tool for work, not for personal enjoyment. So that distinction has to be made, that these non-cash benefits do not benefit you for them to be taxed. They have to be for your personal enjoyment for them to be benefits. Then to this amount that he gets, then he has now to less what we would call the allowable deductions. You will find that as an employee, you have some things that you do that might be considered expenses, but those expenses are either for you to save for a future date or for you to be a member of your career ladder, like a professional body. Like if you're an accountant, you belong to ISPAC. If you are a marketing person, you belong to the Institute of Marketers. If you're a lawyer, you belong to LSK. So any expense that you use to advance your career, like membership to those institutions, any expense that you use for savings, like for retirement or to own a home, and any expenses that you incur for insurance, like life insurance, education policy, and all that, those amounts are supposed to be deducted before you arrive at the taxable income. So now the employer from your payroll will first of all look at all these things: the benefits you received in cash, the benefits you received in non-cash, the allowable deductions, and then get the amount that you're supposed to be taxed. So on this taxable amount, he will apply the graduated scale that is applied by KRA. If you go to KRA's website, you'll find the scale. It says from this amount to this amount, we'll charge you a tax of 20%, 10%, then 20%, then 25%, there is 30%, there is 35%. So based on how much your salary is, then the graduated scale will determine how much tax you're supposed to pay. And finally, on that tax, the government gives everyone what we'd call a personal relief. And it is known to be 2,400 every month. And then they will get the net tax liability. So your pay as you earn as an employee is basically arrived at following this method. Your cash benefits are calculated, your non-cash benefits are calculated, allowable deductions are taken out. Then based on the graduated scale, the tax amount is determined and you're given the personal relief that is due to everyone, and you get your net tax liability. In the next part, we look at business income. And we know what a business is. You know, that entity that you've started, you're doing something with it, and it's generating an income. So whatever income that is generated by the assets or the production process of that business is business income and it's supposed to be taxed. Now, before we go any further, remember that we have already identified that a business can either be run by individuals or it could be run as a registered entity, that is an incorporated entity like a company. But the calculation for the business income is the same. If we take an example of a normal business, maybe you are a retailer in a shop, you're selling goods, you're buying items of stock, you're running the normal expenses, etc. So the first thing that we should note is that a business is taxed on its profits. So KRA expects you to keep proper records, to even have them audited at the end of an accounting period, and whatever profits that are derived from that business, that is what KRA will come from. If it is on individuals, then this profit will be deemed as additional income on the individual, and it will be taxed based on what you've just looked at, the graduated scale. The same way as employment income. If it is partners, those individuals are partners, then each will be given the profit according to his share of profit. And each will be taxed based on how much he has gotten based on the graduated scale. So the first thing that I want us to make clear is that businesses are taxed on their profits. But how do we arrive at this profit? We use the normal accounting method of calculating the income and expenditure or the net profit of a business. We start with the gross income, or what we would call the gross sales, certain amount, and we should note this should be business sales, not non-business sales. For instance, if you are a hotel, you're running your business as a hotel, and along the way you make a sale of one of your assets, maybe you sell a vehicle and you generate an income from the sale of that vehicle. For purposes of taxation, that sale of an item that is not from your business should not be included in the gross sales. Then we have the normal expenditures, which we would call the cost of sales. Of course, for you to be able to sell an item of whatever you're selling, there are those costs that you incur either to produce it or to bring it to the present location and condition. If we get more complicated, for instance, if your business is building and selling houses, so your gross sales will automatically be for whatever house that you've built. Maybe you're selling it for 6 million shillings. But the cost of sales will be all the costs that you have incurred to build, to repair, the transport charges, whatever you have incurred to bring that building that you're selling to its present location and condition. If it's 2 million, then that is your cost of sales. So that now you get your gross profit. of 4 million shillings. Now, this is where accounting for taxation differs with normal financial accounting. Because after that, in normal financial accounting, we list all the expenses that the organization has incurred or has used administratively, financially, etc., until we get the net profit. So these expenses are the normal administrative expenses, that is salaries, wages, transport, fuel, energy, rent, all those are administrative expenses. Then there are the financial expenses like paying interest, charges because of late payments, etc. So all those are financial expenses. And we could also have another category for marketing. Before you make a sale, you have to maybe advertise the houses in newspapers, you have to run a social media campaign, you have to have sales people on the ground, and you have to pay them. So all those costs are taken as expenses. So if we use the accounting method, so this is accounting method, then we'll be able to get all the expenses. And we'll then have the net profit. So normally, we would expect that the taxman will look at this profit and charge it at whatever rate that they will charge to get the tax payable at that point. But that is not the case for business income, because this net profit now is adjusted for what we would call non-allowable expenses. So notice that this is for information purposes only. And if you're keen on getting your business on the right track, especially on matters involving taxation, consult your accountant and they'll be able to explain these things further based on your type of business and based on your industry and the prevailing tax laws. But generally, things like depreciation for assets are not allowed as deductions from these expenses that you've already made. So what the taxman does is add them back to your net profit before arriving at the amount of tax that you're supposed to be charged. Other things are like insurance premiums. You've insured stock and all that, and you're expecting at the end of the month that you'll put that as an expense. Yes, it's allowed in the accounting process, but for taxation, it should be added back because it's not supposed to be an allowable expenses. And the reasoning is simple, that if you have insured something, maybe a car that you're using for your work, and that car gets an accident and it's written off, and the insurance company pays you an amount to compensate you for that car, whatever amount you'll get, then it will not be considered as business income. So the income you get from insurance is not taxed, so the expenses that you pay for insurance are also not allowed. And other things, depending on your business, depending on what you do. And when these are added back, that is when you get the taxable amount. So for a normal organization, that is a corporate, it's known that the tax rate has been 30%. So the taxman will just come for the taxable income, take 30% of it, and you're left with the 70%. For organizations that are in the tax-free zones or that are in the special processing zones like the EPZ, the corporate tax rates have been reduced to enable them to generate more. But as we were saying, whatever this profit is, if this is not an unincorporated organization, it's run by individuals, Let's say that this is a sole proprietor who does the building of houses and selling of them. Whatever income that we get at the end of the day will be subjected to what we've already talked about, the graduated scale, and the amount that is charged will be charged on the individual together with his other incomes. Notice this is applicable to almost all kinds of businesses that you can think of. If it's a farming business, the same thing will apply. You'll have the gross sales, you'll have the cost of sales, how much you used to cultivate the shamba, etc. You'll have the expenses. You paid casual laborers, you have a farm manager, you have a loan, so you're paying interest on it. You have people who are marketing your produce, etc. And since you have a tractor and all that, things like depreciation on those fixed assets will be added back. Things like insurance premiums on those assets will be added back. And that is how you arrive at the taxable income. Although not many people know how to maybe go about it using this method, that is, this is what maybe we learned in school, this is what is taught. KRA has actually done a good job in providing a template that will help you or will assist an accountant to be able to fill in this data without having to struggle to go back to the textbook or think about the treatment of such items. And if you go to the normal filing template, as you can see, it asks you whether you have other income other than employment income. When you say yes, it assumes automatically that that is visitor's income. Then you'll find that when you go now to declare your income from business, it will tell you to declare the gross income, whether it's from manufacturing, whether it's from farming, whether it's from investments that are generating interest, etc. And at the end of it all, it will also tell you to declare the assets that you have. So the statement of financial position has, again, to balance. If you have assets that are depreciating, it will not allow you to charge depreciation as an expense. Instead, it will allow you to calculate what we call capital deductions. Again, KRA provides a template for that. You list all your assets. It knows the system has been programmed with the rates that each item will be deducted for, etc. And at the end of the day, you will be able to declare the income that you've generated for that year, whether as an individual or as a business. Then we come to rental income. So rental income, KRA has done something about it. It has divided it into two. One, rent amount less than 15 million per annum, and rent amount more than 15 million shillings per annum. So if you are a landlord, whether as an individual or incorporated as a company or an organization, and your rental income every month is between 280,000 but less than 15 million per annum, then you file what they call the monthly rental income, MRI. And this basically means that your gross rental income is subjected to a standard rate of 7.5% per month, and that is the amount of tax that you pay to KRA. So if, for instance, you have 10 units in your building and you're charging, let's say, 30,000 for every unit, then at the end of the month, your income of 300,000 is subjected to a tax of 7.5%, which is what you pay to KRA. What this means is that when it is charged on the gross amount, you don't deduct expenses or costs that were incurred to help you generate the 300,000 income that you generated during that year. And that is the major difference between the MRI and for landlords or organizations with the rental income that is above 15 million shillings per annum. So what happens now in this case is that these people will be allowed to use the method that you've just looked at for business incomes. That is, they'll be allowed to calculate their gross income. Let's say it's 15 million. So if we say here the shillings are in thousands, they'll be allowed to calculate the cost of sales or whatever cost that they have incurred to be able to generate that income during that period. And these costs and other expenses, like if there is a caretaker, the caretaker is supposed to be paid a salary. If there are repairs being done to the premises and repairs that are not in capital nature, like replacing a whole roof would be considered a capital expenditure that would increase the cost of the asset and not as an expense. But all those expenses that are incurred to be able to generate that rental income are allowed as a deduction, including if this person took a loan to be able to develop that item, they have the interest expenses that they pay on the loans. In the first case, even interest expense is not allowed to be deducted before arriving at the taxable amount. But in this case, all those expenses that the landlord or the organization that is charging the renting cars are allowed as deductions, and the net income is generated. Then the tax rate is charged based on whether it's an individual. If it's an individual, we use the graduated scale. We've already talked about it. If it's a company, we use the prevailing rate for companies, which is probably 30%. So rental income is a business income, but it has two treatments. One for the MRI, that is the monthly rental income, where the gross amount of rent that you collect per unit is charged at 7.5%. And the other one is where if your rental income is above 15 million shillings and you're allowed to calculate it like you do for normal business, where you deduct all the expenses that you incurred and you charge the taxes based on the net income after expenses. The only good thing is that if you're here, if you're a property owner and you're paying 7.5% taxes, but you feel whatever you're paying could be lower if you're allowed to deduct the expenses that you incur to maintain that property, then you can write to the Commissioner of Domestic Taxes and you request that instead of paying the 7.5% MRI, you pay based on the business calculation that you've looked at. So that is a brief definition of taxation, how taxes came about, how taxes are considered taxes in Kenya. Note that you've not talked about things like the duty on importation of items. We haven't talked about the turnover tax. We haven't talked about the e-teams, etc. But those are things for another lesson. For now, this is JephKafka TV.